In this week's video, we'll review the latest charts to help us answer the question, are investors about to repeat the mistakes of prior generations? We'll be covering a wide variety of topics this week, and we'll close with some eyebrow-raising data. One of the most important aspects of investing is understanding your own psychology in relation to market psychology. It's typical for human beings to suffer from recency bias, and it's incredibly important for us to understand that recency bias is a fractal concept. From a shorter-term perspective, the last 3 years, when we get up here in the present day, we all know what's going to happen. We all know what's going to happen. We're going to plunge. And when we start to move away from the 200-day moving average, we all know what's going to happen. Eventually, we're going to plunge right through it. We're going to plunge right through it. And from a longer-term perspective, we all know, since the market's been rallying for years off the 2009 low, that the way that bull markets end is like this. They peak and then they drop 50%. They peak and then they drop 50%. Is it prudent for us to believe that we know what 2021 will look like? As always, we'll answer that question with facts. We'll be moving very, very quickly. Feel free to use the pause button on your video player to study charts in more detail. Nasdaq Technical Index, we're going to be looking at data going back to 1988. It's relatively rare for the technical index to get down to this level here and then sharply rally back to this level here. This is something that we can see, measure, and put in a model. Historically, does something like this happen before something like this, before something like this, or before something like this? The answer? The only times dating back to 1988 where we've seen a similar move. One of them ended in 1991, another one ended in 2002, and the third one ended in 2009. Thus, throughout the entire video, we'll be asking, does this data that we have in hand align with or contradict the position of many in the markets that think they know what comes next in 2021 and it's going to be something like this or this? Thus, to answer that question, we should ask and answer. How did the stock market perform from this point here, and this point here? All three of those points are very, very similar to January 15th, 2021. The answer is the stock market performed extraordinarily well, and the data that we have in hand contradicts that hypothesis. In all three cases, the stock market was higher 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. How about maximum drawdowns from the date of the signal? Average drawdown less than 4%, median drawdown less than 1%. This case here tells us we should keep an open mind about a wide range of outcomes, even if really good things happen, as was the case after this point in 2002. The market was 17% higher 1 year later and 54% higher 4 years later. But to get there, you had to withstand a 10% or 11% drawdown from the date of the signal, which would be similar to January 15th, 2021. All of this helps us keep an open mind about better than expected outcomes over the next 6 months to 4 years. And the data in the blue box doesn't align with the theory that we know what comes next, and it's a major top. We all know the CCM market model uses a weight of the evidence approach, so let's move to NYSE stocks greater than their 200-day exponential moving average and see what we can learn. Similar situation here. Relatively rare to be all the way down here and shoot rapidly back up to this level here. Thus, does a move like this tend to align with this type of hypothesis or contradict it? If we look at all of the data that we have going back to 1986, the only time we've seen a move similar to this move here that ended on February 8, 2021, the other one ended on December 26, 2003. What happened next? Keeping in mind that December 26, 2003 is similar to February 8th of 2021. The S&P 500 rallied over the next 47 calendar days and gained an additional 5.65%. And then it gave all of that gain back and then some, with the maximum draw from the date of the signal here being roughly 3%. Thus, performance looking forward 1 year from the date of the signal, 2 years, 3 years, 4 years, and over the first full year, asking what happens next, does it align with or contradict the bearish hypothesis? From a short-term and longer-term perspective, the answer in this case is a resounding contradict. Here's S&P 500 performance walking forward from the date of the signal. 1 year from the date of the signal, the market gained 10.42% if you didn't lose your cool during 100% normal and to be expected volatility that occurs even within the context of the strongest bullish trends. And it's important to keep in mind, this figure here is from the date of the signal, and this figure here is from the date of the signal. Thus, this move here, peak to trough, is quite a bit bigger than 3%. Are we seeing signs of institutional selling in the background even while the market is rising? It's a relatively noisy chart, but it's easy to understand. This is a percentage of Nasdaq stocks making new 52-week lows. How is this potentially helpful? This is the S&P 500 here. This is the peaking process after the dot-com bust. Here's the peak right here. Look to the right of the peak. Volatility starts to pick up, and then as we peak, the number of new lows starts to expand rapidly. So in the present day, if we start to look a little bit more like this, we would get a little bit more concerned. How do we look in the present day? As of February 5th, we're all the way down here. Also noteworthy, notice the magnitude of these spikes between 1998 and 2021. And then let's look at 1987 to 1990 and compare and contrast this and this with one of the strongest periods of the secular bull market, 1991 to 1997. Moral of the story, we shouldn't assume anything. We shouldn't assume that the next 10 years are going to look like this red box. It's quite possible in the future we could morph into something more like this, helping us keep an open mind about a wide range of outcomes. This chart's dated February 5th. If we look at a daily version of the same basic data, nothing alarming yet as of February 10th. Is there anything else that can help us? It's a weekly chart. Nasdaq new highs going back to 1990. It's relatively rare to see a shift from way down here to way up here. In fact, going back to 1990, it's only happened one other time. The low here in 1994, and then the high here in 1995. Notice how high we are here. We don't hit it here. We don't hit it at any time in here. This is a change in character. This looks different from the rear view mirror and looks a lot more like this period here. So based on these facts that we have in front of us, do they align with or contradict the hypothesis that things have to get bad soon? If they align with that hypothesis, we would suspect that subsequent S&P 500 performance walking forward from this similar date, which is similar to early 2021, that we would see a lot of yellow and red in these tables here. S&P 500 performance walking forward from this date, Nasdaq performance walking forward from this date. Are we getting a lot of orange and red? It's really just the opposite. We're getting a lot of green. In both cases, the stock market was higher 1 month later, 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. From this point here in 1995, the market had had a nice run off of this low in 1994. If your attitude was, I'm going to wait for a pullback or predict that there's going to be a pullback, that didn't work out very well. The 1 year draw on the S&P 500 was less than 1% from the date of this signal. The 1-year maximum drawdown on the Nasdaq less than 2% from the date of the signal. And this date here, the only other date that's similar, is this point here in Q1 of 2021. The signal date in 2021 is January 8th. The S&P 500 closed at 3824 on January 8th, telling us with some back-of-the-envelope calculations from the close on February 11th, 2021, if we saw a similar drawdown to this number and this number from the date of the signal, the drawdown from the 11th of February would be somewhere in the order of magnitude of 3 to 4%. And in the real world, a 3 to 4% drop can be pretty painful. So we have to have realistic expectations about how markets operate in the real world. We can't get fixated on the green and expect the market to go up every day, even if something like this happens. All right, so far we've covered the Nasdaq Technical Index, and that hard data, something that just happened in 2021, tied the present day to 1991, 2002, and 2009. Then we looked at NYSE stocks greater than their 200-day exponential moving average. And that hard data, facts, no opinions, no emotions, tied 2021 to 2003. And Nasdaq new highs just tied the present day, something that just happened that we can see, measure, and put in a model. Q1 2020, it tied it to 1995. Anything else? To answer that question, let's look at the Nasdaq Volume Momentum Oscillator. Once again, pretty rare to be down here near the green line in 2020. This is the March low of 2020 in the stock market. And then have a breath thrust that takes you back to the blue line. Going back to 1981, once again, this is a change in character, telling us that we should keep an open mind about the S&P 500 acting differently, walking forward than it did in this window here. What can we learn about the present day by examining the points in history that are similar to this point here? And they came in 1982, 1985, 1988, and in 1991. In each one of these cases, the market rallied from an oversold level, rallied from an oversold level, rallied from an oversold level. Did that occur near a stock market peak or even a major correction peak? Looking at subsequent S&P 500 performance, we would surmise the answer to those questions are no. In all four cases, the stock market was higher 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. Average gain 12 months from the date of the signal or 1 year out was 15.24%. The average gain 4 years later from the date of the signal was 55%. And this is a weekly signal that has been nailed down. It is in the history books, and it looks different from anything in here. Green tables can skew reality day to day. Thus, it's also helpful to understand what the maximum drawdown looked like in each case from the date of the signal. Notice in 2 of the cases, the market basically never looked back from the date of the signal. In the other 2 cases, the maximum drawdown from the date of the signal was less than 6%. Average drawdown about 2.5%, median about 2.4%, and it's also noteworthy. They occurred relatively quickly, approximately 40 calendar days from the date of the signal, and then the market marched higher and did not look back. Thus, if we add this to the weight of the evidence that we've compiled thus far, we're starting to put together a who's who of major bottoms and outstanding long-term bullish entry points in stock market history. The Nasdaq Volume Momentum Oscillator added 1982, 1985, 1988, and 1991. If we take an inventory of all of the years that are tied to Q1 of 2021, we see we have 1982, 1985, 1988, 1991, 1995, 2002, 2003, and 2009. It's also noteworthy that all of this, things that we've just seen recently, all of it aligns with all of the hard data that we've been covering in these videos starting in roughly early April of 2020. All right, we've looked at a lot of technicals. How about if we look at some fundamentals? You can pause your video player, CNBC article dated January 6, 2021. Cash in circulation is soaring, and that usually means good things for the economy. Cash in circulation year-over-year gain 2020, 11.6%. Very similar to what years? The answer? 1983, 1991, 2002, and 2009. 1983, U.S. was heading out of an inflation-induced recession. 1991, country was coming out of an economic downturn. 2002, following the hangover from the dot-com bust, and 2009 is on the other side of the financial crisis. So this is fundamental data here, and it really has nothing to do with the technicals that we've covered. So keep in mind, here are the years. So we're going to cut and paste this text here with these years and compare them to the signals that we've covered this week. Fundamentals say 2002. Technicals say following the low in 2002, we look similar to 2003. CNBC article says 1983, we have 1982, we already covered it. 1991, covered that as well. And once again, investor behavior. This is investor behavior here. Aligns with the rare fundamental factor. Covered this earlier in the video. 1991, technically based. 1991, fundamentally based. 2002, technically based. 2002, fundamentally based. 2009, technically based here, fundamentally based in the CNBC article. Anything else that we've seen recently that helps us keep an open mind about better than expected outcomes, much better than expected outcomes, rather than a major peak? The answer is yes. These are daily candles for the VIX. This is strong buying pressure in fear about future volatility, and this is a very rare reduction in concerns about future volatility. In fact, something like this, a 5-day rate of change drop, has only happened 5 times in the 31-year history of the VIX. We have data going back to 1990. How did the stock market perform in the previous cases? From a longer-term perspective, quite well. 100% of the cases higher 2 years, 3 years, and 4 years later. This period in here helps us keep an open mind about a wide range of outcomes over the next year, which is exactly what was represented on this chart that we covered earlier in the video. This says the next 12 months, in this case, not particularly easy, quite volatile, but if you kept your wits about you, the gain was almost 11% at the end of the year. And from a purely anecdotal perspective, we can see some similarities to this shorter-term move in the VIX here, and then a dissipation of fear between March 16th, 2020 and March 23rd of 2020. Big spike in concerns about future volatility, and then a big give back, and then a big give back. And we all know March 23rd, 2020 was the date of the major low in the S&P 500 index. The market has rallied from March 23rd and never looked back. And it's worth noting there are actually 6 occurrences in the study, but these 2 are related to the same type of reversal and bottoming process off of a low. Let's quickly gravitate back to human nature. If you and I were having a conversation and we said the stock market cannot go up every day, or we made statements similar to the ones shown on your screen, these type of statements seem really ridiculous when the markets are closed. Everybody knows the stock market can't go up every day. And we do know that. It's just important to keep that in mind during the trading day, especially on days when there's red all over your screen and your balance is falling. It's not possible for your account balance to go up every day. We all know that. One of the ways that we can help ourselves calm down is to have levels where we say above this level, I'm sitting tight. Below that level, I may need to take some action. Anything that we can do to reduce stress and anxiety will improve the probability of producing favorable outcomes. Longtime viewers will remember the concept. Really what this is all about in the stock market is discerning between volatility to ignore within the context of an established and ongoing uptrend and volatility to respect where the trend starts to roll over and can turn into a downtrend. Notice, the volatility word appears in both cases. And notice, we're not trying to avoid market volatility. There's nothing we can do about market volatility. We have to embrace it, we have to accept it, we have to learn to live with it. And in our case, volatility to respect is identified when the data on multiple time frames and from multiple sources changes in a material manner, similar to what occurred in late February of 2020. After the data started to turn in a meaningful way, really bad things happened, specifically the fastest 10% correction in S&P 500 history. And that's why the concept of maximum flexibility is so important. The statements that we make in these videos are based on the data and facts that we have in hand. If the facts change, we have to be willing to reassess the probabilities. You may remember in the January 8th video of this year, we noted this chart of JNK relative to IEF was worth watching. Has the data deteriorated on this chart? Meaning, are we getting a look like this, or bad things happened in the stock market? As of the close on February 11th, 2021, probably fair to say that right now this looks discernibly different from this. This looks discernibly different from this period in here and this period in here. Is it possible we're getting a look like this and then we're going to look like this? Sure, it's possible. That may happen very, very soon, but it hasn't happened yet. And there's nothing magical about viewing JNK versus IEF in isolation. We're simply using this as a proxy for the weight of the evidence that we're seeing from multiple sources on multiple time frames. We just reviewed 4 new studies, and we reviewed some fundamental data from the CNBC article. And it's probably fair to say that all of that tends to contradict the hypothesis that we all know what's going to happen in 2021. It's going to be something like this, or this. This is what the last 3 calendar years look like. This is the 50-day, the 200-day, and this is price. This is a mess. This is a mess. This is a major bear market, and this is a major bear market. The data that we have in hand today is tying the present data, 1982, 1985, 1988, 1991, and 1995, along with some other periods that we've mentioned. Notice the look of the same 200-day moving average and 50-day moving average relative to price from a long-term perspective, especially in the 1991 to 2000 window. This doesn't look anything like this, helping us keep an open mind about a wide range of outcomes, from wildly bullish 1995 walking forward. We rarely drop below the 200-day moving average, and the 50-day rarely drops below the 200 for several years. That looks significantly different from this and this. And the studies that we've just covered tie the present day to some of the strongest trending periods in stock market history. Also noteworthy, here's the end of the secular trend in the year 2000, and look what happens to the right. It's just a mess. This chart goes to the end of 2012. If you know your market history, in 2013, we break above. So this is really as of January 1st, 2013. It does not show to year end. Anything else that tells us we should be open to a change in character relative to this period, walking forward from the year 2000, when the secular trend ended? The answer is yes. We've covered this in detail in the past. Here's an updated version of the equity put-call ratio. Notice the ratio stayed inside the box the entire time after the peak of the secular trend in 2000 while all of this was going on. And we stayed in the box into the year 2020. This, too, is a change in character. And that's what technical analysis is all about. This is telling you that human beings are acting differently in the present day than they were at any time dating back to the year 2000. And this is telling you that human beings in the present day are acting differently than any time in this window here dating back to all the way to what period? 1995. 1995 is right before the strongest part of the secular trend. This isn't just a bunch of lines on the chart. This is the action of some traders. And we're trying to figure out what that might tell us about the future action of other traders. Here's 1995 here. Look at the character of the market here. Price above an upward sloping 200-day moving average. Compare and contrast this look with this disastrous look here that favored balanced portfolios. A balanced portfolio is the last place you want to be right here if you're interested in growth. If we take the time to revisit one of the studies that we covered earlier in the video, we can learn quite a bit more about the probabilistic significance of this change in character on the right side of your screen. And that type of action hasn't been seen since this area here on the left side of your screen. If we take these exact same dates and extend historical market performance out 9 years from the date of the signal, the results scream secular trend. Average gain in the S&P 500 index 5 years out 81%, 6 years out 96%, and 9 years from the date of the signal, a gain of 212% in the S&P 500 index. And we've been talking about the probabilistic significance of secular trends in these videos for quite some time, dating back to 2016. And yet, this is the first time we've seen a signal like this. This data point here and these data points here align with, rather than contradict, the secular trend thesis that we covered again on December 18th, 2020. You can find that video by Googling the title shown on the right side of your screen. As we all know, none of this predicts anything. It helps us understand and assess the probability of good things happening relative to the probability of bad things happening. And it's noteworthy that 1995, based on data that we have in hand today, appeared in this week's video again. Under our approach, and yours may vary significantly, the only way any of this works is if we head into next week and every week with a flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.